Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Now, a lot of you would have seen and probably commented on a tweet that I put out. I'm just pulling that tweet out. And that is how we have hit for the global stock markets the $100 trillion market capitalization mark. We've hit it. And we are at that peak. And I think global equities, by and large, are participating in it. It is not an isolated uh, 4 3 4 economy 3 4 stock market event. I think global equities, by and large, have moved up in a COVID-induced world. So the point is, or in a COVID year, right? So in the point is, or the question to our guest today is, how does he feel about the rally, and whether there are telltale signs which tell him that there is more upsides over the course of the next few years, or is he cautious in the current scenario? Nirav Sheth, for the first time in his new capacity as CEO of institutional equities at Emkay Global, joins in right now on the show. Nirav, so good having you. Hope all is safe.
Thank you, and good to be back, Niraj.
The pleasure is ours, Nirav. So tell us, Nirav, how are you seeing the current market scenario? Because world over there is a rally. Yes, easy liquidity, lower interest rates are probably the reasons that everybody talks about. What next?
Yeah, so I think that broadly we've been surprised in terms of the pace of economic recovery, not only in India but globally as well, right? So, and then you put that in the context of, like you highlighted, that you got lower rates for longer. I mean, think of it. Even in India, you had an explicit statement yesterday by RBI governor on Friday. We start about the fact that you will have an accommodative policy in FY21 and right into FY22, which means that you are de-anchoring yourself from whatever fluctuations on the inflation that you are seeing. So I think that delta in earnings, delta in interest rates, and top that up with liquidity. So I think I'm fairly constructive on the markets. We have no great idea in terms of what the markets will do in the next month or two. But I think that if you take a year perspective, can the market be 30% higher? I would vigor on it.
So if Nirav, the bet is that over a 1 year period, the markets can rally, say 20, 25, 30%. It naturally has to be led by earnings growth, right? Because I'm presuming that you would not bet on a valuation re-rating from these levels.
You will not necessarily bet on a valuation re-rating, but you can certainly bet on a valuation distribution. I have been a big vocal critic of the fact that the market has distorted valuing growth and X growth, right? Let's say, for example, I have no great view on whether, a company growing at 30% should be trading at 5 or 6 times book value. But hypothesize, I mean, let's say, for example, SBI is X growth, which means that you can probably, let's say I own entire of SBI, right? And it's not going to grow. It's trading at roughly about 0.35 times book. And it pays out all that it earns to the shareholder, right? The return on that will be close to about 25%. Now that is stupid, because you're not going to essentially believe that there is no going concern value in State Bank of India, right? So I think that you had a big disconnect between what you would call valuing X growth. Now, can you envisage a case where SBI can double? Of course it can double, and it will be trading at 0.7 times book. And can it double again? Yes, it can double again, and it can trade at 1.4 times book, assuming a normalized level of ROE about 10%, 12%, or whatever that is, right? So there is immense scope for valuation distribution is what I would talk about in that, which means that you are going to see a broader rally in the markets. ONGCs and, we are talking about PFC, RECs, they are not necessarily the greatest earnings model. But then what is the value of that earning stream is that can be debated.
Am I understanding this correctly, Nirav, that you are saying that the market in its wisdom is mispricing some of the badly beaten down stocks, and even if they do not show an earnings growth, just a mean reversion in a world which is fueled by cheap money will bring these stocks higher, and you would rather bet on them as opposed to companies which are priced to perfection, so to say?
So I'm saying, I'm not necessarily saying that X growth. I'm saying I just made a case for an X growth, right? The question is that can SBI grow at 8%? ONGC, whatever 2-3% or whatever it is. All I'm trying to say is that on a scale of earnings growth and P, there was a distortion at one end of the market, right? And probably that was because you've been waiting for earnings growth in some of these stocks for years, and they have, that never materialized, right? And what you need is earnings kicker, and I believe that the markets eventually has to price that. So yes, I see a lot of scope for a lot of these beaten down stocks, largely supported by pickup in economic growth, and I'll come to that later on. But I do believe that one big difference now, vis-a-vis what was there in the last 8-10 years, is what appears to be a strong comeback in real estate investments.
That's interesting. So Chris Wood in his note wrote Ingredient Fear on third wrote about this. Then we had Mahesh Nandurkar, obviously from the same house, on Friday talking about it. We have you now coming in talking about it. Let's talk about this in detail, slight detail. Why this bullishness around real estate per se, and then the multiplier effect that it can have, and who all or what all benefits from that within the listed space and otherwise.
So let's say, for example, let me accept rightly is not that we had a foresight. We are just reacting to what is happening on the ground and trying to analyze that, right? And what is very surprising is that you've seen a serious pickup on the premium side. So you can actually argue and say that, my mortgage rates are 6.7% and the rental yields are 2.5%. You make some adjustments for tax benefits, and therefore the cost of ownership is significantly more appealing than cost of leasing the asset, right? So, but that is for below 70 lakhs property. What explains the pickup in premium properties? This is true, and what started off in an anecdotal fashion now seems to be a trend which is witnessing across the cities, luxury villas, holiday homes, everything, right? So there is an NRI demand apparently that is also coming. So let's try and understand the context of how big this segment is, right? So residential investments all put together is roughly 50% of all my investments. So that is government plus state capex plus private corporate capex put together, right? And that was dragging down your economy significantly because we are almost an 8-year bear market cycle, and these things tend to move in cycle. Look at the inventory data, right? In most of the cities now, we got inventory ranging from about 34 to 38 months. When a project is launched, it becomes a part of the inventory, right? But actual finished good inventory would be closer to about 12 or 18 months. So I think everything fits in pretty well. Strong forward backward linkages, steel, cement, building materials, you can go on and on. And this hypothesis to us is critical to whether we can have a reasonable demand in growth rate beyond what we are seeing, which can be argued to be some level of or a mix of pent-up demand and some real pickup in demand. But if you have real estate demand kicking in, as we believe it seems to be the case, then I think you are set for a durable recovery in economic growth rate. And that is one of the pillars for our being constructive on the markets.
So what's the best way to play this, Nirav? Would you try and pick and choose from within the listed real estate plays which one is the best place to do this? Would you rather play the ancillaries? Because whichever real estate company, whether listed or unlisted, does well, it will require steel, it will require cement, it will require building materials, and therefore maybe play on the best plays in those pockets. How do you play this?
So I am still approaching real estate investment from the larger impact that it has got on the economy, right? So I am not necessarily still saying that you want to buy this particular real estate company because that requires a second level of detailing in terms of valuation, in terms of the balance sheet strength and stuff like that, right? And you don't necessarily have to get very bullish on cement or for steel because they have different dynamics. All I'm saying is that the broader impact on the income stream, right? The broader impact on the employment, it is going to be widespread. All of us have been waiting for corporate capex to come back. I don't think it's going to come back because the profits have to come prior to capex coming back, right? Sure. You have the elements of a big part of investment cycle apparently kicking in, and there could be a wide impact in terms of income growth and stuff like that. So you can look at mortgages, for example. I think is a better way of playing that cycle. Building materials, which have probably more definable business models and some level of moat to some extent, could be one of the things. But let's say what I'm looking at, right? You've never seen growth in the lower end of the cars because you've never created enough jobs, right? Because so I think that structure of the economy can change. You'll have probably more demand in altos of the world, which is what you're seeing at this point of time. And you had seen a similar in some form in 03 to 08. I will not compare. I'll not make the mistake of comparing them. It was a $300 billion economy. You are a 2.2, $2.3 trillion economy. The dynamics are completely different. But yes, some levers of growth, I think, seems to be falling in place there.
Yeah, Nirav, pardon me for going down the micro route, but I've seen often that in trying to predict the macro at times, you kind of doing a toss of a coin, right? Because you don't know. There's so many variables, and therefore maybe staying bottom up might be better, and which is why I went to that topic. But let me dwell on that point a little bit, and then we'll come to the larger investment cycle piece as well. Um, this argument about real estate uh, getting its fair share of uh, uh, presence in the GDP after having washed down since 2009-10 is a decade-old argument, and hopefully now it's coming to be true. The only point that I was wanting to understand is that because the building blocks seem to be in place in terms of lower interest rate, the inventory, etc., that you pointed out, do you reckon that the sector itself could actually uh, have meaningful returns? Also, because somebody made this point about how the advent of RERA could do to real estate what the advent of SEBI did to capital markets 15 years back. And therefore, my question, because almost everybody at every single point of time in the last 10 years, whenever a bull argument for real estate comes, just rubbishes it. And this time, the bull argument for real estate stock investing be different.
Yes, I completely agree. All I'm saying is that I am not ruling out that as an asset class, do you want to look at real estate? Of course, you want to look at real estate. All I'm trying to say is that it's very difficult to try and draw down completely from a macro level argument to a micro level argument, because real estate by nature is extremely localized, right? How much you paid for the land, the sense of the balance sheet and stuff like that. But I do believe that even if you look at, let's say you got about $2.5–3 trillion of market cap in the country, and if you look at the importance of that in the economy and representation of that in the index, it is zilch, right? It is a large sector. It needs to have a respect in the indices, and you're seeing REITs have done extremely well, right? So that is one way of playing real estate, that you will have a lot of churning and a lot of REIT assets getting listed. You've seen huge amount of private equity money that has flown into that, right? And that is also largely because you didn't have great access to your normal funding, and therefore you relied on private equity at a larger, at a significantly higher cost of the capital. To answer your question, yes, I think that you should very, very seriously explore investments in well-run companies and direct stock investments in the sector itself. Yes.
Okay. Again, I mean, one part of my asking this question was when your large clients, institutional clients, both local and global, come and seek your advice about what to do in the current scenario. I was wondering as to what is it that you tell them. So let's broaden that argument to the investment cycle. Where we are seeing some green shoots here, but I kind of find I'm in a bit of a quandary at times when I think about things as to how is it that everything in a post-COVID shock world can look so good, wherein an airline company is saying that we'll all be okay because the traffic will come back, but you also have IT companies saying that 50% to 75% of our workforce will work from home and we will not need to travel. And that would mean that air travel comes off, right? So there is dichotomy there. Similarly for hotels, right? People are saying that we don't need to travel, business travel, etc. But hotels are saying that, hey, we might come back to normalcy. So at times I get caught between this argument. Where is it that you think the winners versus losers will come uh, in the broader market? And then give us your sense about the investment cycle argument that you made.
So, this is an excellent question, and it's not that we've got all the answers. but I believe that there will be massive disruptions that are going to happen, right? I am not a great believer, for example, that you will have the same kind of normal for airline stocks or let's say for multiplexes. I mean, I don't know if they follow this or not, but HBO Max just announced, I think this was on Friday, that they're going to launch all of their movies on the same day digitally as they're going to launch it for theatrical release, right? And I understand that the stock of multiplexes are down 15-20%, right? This is a new normal, right? Let's say, for example,
Sorry,
I'm not.
Nirav, sorry, excuse me. I'm just losing your feed a bit. Can I just request you to repeat that again? You were talking about HBO Max making a simultaneous theatrical as well as on air
Yes,
or rather on the web
right.
release.
There are 18
What would it imply? And then you can carry on your answer.
So broadly, I mean, the normal thing is that you release in theaters, there are ticket sales, the multiplexes make money, and the second leg you try and release that digitally. Now they are saying that they are going to release all on the same day as they are going to release in the theaters, right? And the stocks of multiplexes in US are down 15-20%, right? So the broadly, you don't know what sort of value is migrating where, right? So you always thought that ER is a great story, but we don't know necessarily because we are all used to now seeing blockbuster movies with the same kind of production values releasing digitally. And if it makes sense for the content producer to release digitally, he'll release digitally. He's agnostic to saying that I need to support the multiplexes. Let's come back to airlines, right? I don't have an answer to it. I'm just taking you through in terms of how I would think through things. Let's say, for example, airlines, you make money once the occupancies hit 75-78%, right? All you have to argue that the new normal is 70% occupancy and not 95% occupancy. So till the time the supply doesn't crunch, you don't necessarily have profit dynamics working over there. Likewise in hotels, you anyway had disruptions in form of Airbnb and stuff like that. So I think that supplies will need to get recalibrated, right? So I am not the one to go and latch on to an airline stock or a hotel stock or a multiplex stock, assuming that it is a post-COVID world. No, I think there are too many ponderables over there. We don't have an answer in terms of how the human behavior is going to be a year down the line. And there are outside that there are enough opportunities. Why do we want to try and estimate something which we believe is not knowable right now?
Fair point. So having established that, and I'm glad you said that, because yes, it's a fact that there are so many ponderables out there or imponderables out there that you don't even know what the right answer is. Let's talk about things which have more predictability and more certainty of happening. Investment cycle. Give us your thesis. I think you mentioned that it's real estate led. How does it play out? How does an equity investor benefit from that?
Equity investors largely will look at overall impact, and then you look at the different segments. Let's say if it's real estate, then what are the forward backward linkages? Some of them we talked about it. The broader thing is that if real estate investment cycle, which is like I said, half of my investment to GDP ratio, if it's able to move in a sustainable fashion, then you'll certainly have the next level of capex investments, which is corporate capex, because then you would need steel, cement, and stuff like that, right? So someone has to lead. When economy starts growing at 7% or 8%, then you'll obviously have follow on happening from the other part of the investment cycle. What we are not very clear about at this point of time, and which I think is a critical assessment needs to be made, is what happens to the government capex, which is both at the state level and at the level of the center government, because your finances are in a different shape. You are mentally, there's a mental block that you created in terms of excessive borrowing and investments. And that's a very, very critical piece that needs to fall in place. I believe that time has come to start create some sort of sovereign wealth fund. You are sitting on $600 billion foreign exchange. Last 25%, you never use it. It is just precautionary, right? And it's time to start using that money in terms of trying to build the capacity. That is an existing demand that is there in the country. You can still argue whether you want some of the capex. Let's say, for example, I'm not sure whether you'll be very excited about one more oil field. There are ESG concerns. You're not sure whether you need utilities because renewables are coming, stuff like that. Infrastructure, there is massive existing demand. right? You just need to unclog the wheel in terms of IRR for the private capital, and wherever the subsidy needs to be given has to be given by the government. But in my order of packing, to answer your question, real estate to be followed by corporate capex cycle in 24 months down the line. Government is entirely in their hands in terms of how they finance it.
Okay. What about services, Nirav? And almost every conversation that I have with IT companies or report that I read from analysts who host these companies, the bullishness is all pervasive, even if the valuations may have moved up from where they were a year ago or compared to averages. How constructive or less constructive are you?
I am less constructive on software services. For example, I don't think that cloudification is necessarily post-pandemic reality. It was there. I mean, Microsoft started getting re-rated from 2014 and 15 onwards after launching Azure, right? So is the Amazon and stuff like that. So cloudification is nothing new. Secondly, put this in perspective. After all these things, let's say if you look at FY21, right, you will still have, except for Infosys, I think Infosys will grow at about 3.5% in constant dollar terms. You still have declining revenues from TCS and Wipros. And if you look at next year, on a depressed base of the current year, you're talking about 12 or 13%, at least for the larger peer companies, right? Over a 2-year time frame, they are doing exactly what they're doing 4 or 5 years back, which is 7-8% of constant CC growth rate, right? Where your valuations are 2 sigma deviations above what they were. So I am not a great believer that there is a third big wave of IT coming and you have to grow in double digits. Obviously, all of us can be proved wrong. I don't think it's very easy to shift $1 trillion of spend that happens over there and suddenly they start growing in double digits. Secondly, my bigger worry is that I'm extremely constructive on the rupee, right? You've been buying dollars left, right, and center, right? And that reflects in the kind of liquidity that you got at the short end, which is almost about 6 lakh crores. You're not able to suck that liquidity, right? At some point of time, the government and RBI will have to decide whether you want to buy bonds or you want to buy dollars, and it will let go of dollars, especially because inflation now seems to be a bit of an issue. All it takes is a 3% appreciation in rupee for your earnings growth to be wiped out by half, right? So I am personally, I'll be underweight on software by a mile.
Okay. Would that argument then extend to all exporters, be it pharma, specialty chemicals, textiles, which is starting to emerge, if conversations with companies are any indication?
Right. So I think what you need to look at the level of valuation that happens in a sector, right? So for example, the sensitivity of a rupee appreciation on pharma will be significantly lower than, let's say, what it is there, because they are growing at 8% and a 4% appreciation in rupee will, for software companies, bring it down to 4% growth rate. Far lower sensitivity for pharma companies because they've got a domestic base and other emerging market currencies and stuff like that. Textiles, obviously, it has got its own impact because the valuation is low and stuff like that. But from a listed company's perspective, when you look at the larger, the one that is most exposed is obviously IT. And I'm talking slightly long term because they do run hedges for 6 months or 1 year, which means that what you lose on revenues, you'll make on hedges. But eventually, after 6 months and 1 year, it starts filtering into that earnings as well.
Fair call. So, my final question then therefore is, you explained beautifully your base thesis. Where is it that, how do I say, where is it that you are an outlier, or you yourself, whether MK as a house or no is separate, but where Nirav Sheth is a bit of a lone ranger of sorts? Where is it that your opinion is starkly different than the rest, and why? Because the reason I ask this question is your argument on real estate, as I said, I think a few people have started to echo it now. So you may have been one of the early proponents of it, but a lot of people are now starting to speak about it. The argument on investment cycle, also a lot of people are starting to speak about it. Where is it that you believe you are an outlier, and why?
Well, I'm not sure whether I'm outlier or not, but I do believe that value as a theme will have more legs to run than growth. And like I said, I just see immense value in some of these beaten down stocks by miles, no matter what kind of sensitivity on earnings that you run. Secondly, I also believe that, so broadly, I think if you look at what has worked over the last 8 or 9 years, is that you've seriously concentrated portfolios, few good quality stocks, and that has worked beautifully well for a lot many people in general. Which means that generally the focus on the broader market has been sort of diluting. I believe that time has come when you will have a serious amount of breadth doing well. Economy does well, large number of companies will tend to do well. Some of them are coming off extreme low valuation base. So one of the things that I talk to when I talk to some of the CIOs is that it's probably time to run a portfolio of 100, 200 stocks. You'll be surprised in terms of what can happen in next 3 or 5 years, right? Because a lot of people don't want to get into illiquid stocks. How do you cut the risk? You cut down the size of the weight, right? But if you believe that, the business model is good, the management is of good quality, you believe in the business economics of the model itself, then I think that you should run far a wider portfolio across the spectrum of market cap breadth, which I believe that I could be an outlier over there, but that is my belief. I have no idea what others are thinking.
No, that's interesting, and it's a bit of a rare thought, so it's good to have that. But Nirav, pleasure talking to you today. It's been a while, but I'm glad that we spoke, and I look forward to talking to you again very soon in the new year.
Likewise, extremely nice talking to you. Take care.
Thank you so much for joining in today, Nirav, and wish you a happy new year. And viewers, thanks for tuning into this edition of Talking.